India-China trade talks have progressed well and has translated into a mini deal. Finally, the markets can now breathe a sigh of relief as US has agreed to suspend its next tariff hike on Chinese imports, which was scheduled for October 15th. US President said the negotiators had reached the phase 1 deal that would include increased agriculture purchases and address financial services along with technology theft. This development is expected to be welcomed with both hands by the markets. The domestic data published last week were relatively tepid. The IP numbers reported for August 2019 were reported at minus 1.1%, dragged by contraction in manufacturing output and slowdown in capital goods. Slowing economy now puts ball in RBI's court. Another rate cut of around 25 bips cannot be ruled out in next 6 months. We have released our bouquet of Diwali picks. Our Diwali picks includes a mix of large, mid and small caps from various sectors. We feel a portfolio of these stocks would outperform the CNX 500 index in coming year. We have identified HUL, Kotak Bank, ICICI Bank, Asian Paints, HCL Tech, SBI Life, Dr. Reddy's Lab, Aarti Industries, Mindtree, Rights, Dixon Technologies, and Lumax Industries in our Muhurat picks, Diwali Muhurat picks. Coming week would be marked by results from prominent names like HUL, ACC, and Ambuja Cement, and the big boy Reliance Industries, along with other companies. Markets would also be keenly watching out for the minutes of meeting for last RBI's MPC meet, and the minutes of meeting are scheduled for release on October 18th. For this week, we have identified Ashok Leyland as our pick of the week. Ashok Leyland has corrected significantly, and the price erosion, which includes the price erosion of almost 60% from its high of rupees 167. We believe that at its current market price, it has priced in most of the negative factors, namely liquidity issues due to NBFC crisis, one of the worst demand slowdown, asset load norms, etc. We believe, having priced in most of the negative factors, the sequential increase in vehicle sales due to discounts, festive season buying and pre-B6 buying would start reflecting in prices as month-on-month demand picks up. In the recent past, there has been lots of reports on government working on plan to cap the life of vehicles to 10 to 15 years and set up guidelines and rules to allow structural scrappage of old vehicles. Policy framework on this is already a work in progress, and government is expected to announce something definitive sooner than later, as the government is quite keen to revive the demand in auto industry. This may act as an X factor for CV manufacturers, including Ashok Leyland. In these days of demand slowdown, management is looking at every aspect to reduce cost, be it manufacturing, people, productivity overheads, etc. They are having regular meetings across all functions to look at cost cutting areas. They estimate a cost reduction of around 400 to 500 crores for FY20. This would make Ashok Leyland much more efficient operationally and would augur well when the cycle turns. Ashok Leyland has been trading at its lower end, that is near mean minus 1 standard deviation of its price to earnings based valuations for past several months, and even a mean reversion to its historic valuation translates to a 10 to 15% upside in the stock from its current level. With CV cycle going through the trough, government focused on demand revival, which is being seen through fiscal initiatives like tax cuts, accelerated depreciation, etc., along with other demand impetus such as discounts, festive season buying, and pre-B6 buying would lead to a rebound in price of Ashok Leyland to its mean price to earnings valuations. We maintain a buy with a target price of rupees 79 on Ashok Leyland. The risk factor for this stock remains, which would be demand does not pick if the demand does not pick up in coming coming months, and there is no policy support or stimulus from government to support the CV industry. That's all. Thank you.